I've been profitable backtesting for years. I've been profitable on a demo account for years. I've been profitable on a live account, and I'm buying my first ever 100k funded account this month. After 4 years of trading experience and being able to get to the position I am in now, these are the three confluences I used the most and made me the most money. So, firstly, before I actually tell you what they are, you guys need to understand that the first thing is to identify them, which I'm going to get into now. And then, once we can identify them, we need to be able to understand them to then allow us to know where and why they show up in the market. And once we understand all of that, we can then finally implement them into our own trading. So, what actually are they? The first and most important in my eyes is liquidity. And it's it's how we use liquidity. And a lot of these confluences people believe are just foolproof, sort of like just basically they just use it as a strategy to attack the market, and they don't think of it any deeper than that. Because I bet you there are some days I can pick out my strategy that works in two directions. So this is a trade that I closed and won today. So there's proof for you guys that this stuff actually works. But before people think that these confluences are just going to make you profitable instantly, they also work in two directions. So you need to use them together to create, and with market experience and understanding, then you can finally decide in the direction of the market. So a lot of people just think, oh, liquidity, we're going to look for a liquidity sweep. And when we see that, we see, oh, a low, we got broke under, but then we don't also. This is the bad example because it's a news one. Let me find a good example. Okay. Um, well, here. So this candle here came up 1, 2, 3, 4, 5, 6 highs we've taken out. That's a very big liquidity sweep. What happens when that candle closes? Do we go lower? No. We continue higher, taking out even more liquidity. So, or the other direction, you can say, oh, look, we came down, we took out all this liquidity. That's why we went higher. So these confluences, they work in both directions. You guys just need to implement your market experience with these confluences to create the outcome of you actually being profitable. But let me not waffle on anymore and actually get straight into it. So what actually is liquidity? So liquidity is the space or the area underneath, or that's how it's underneath, under or above. Let me make this a bit bigger. Bruh. Nope, that's not what I wanted to do. Yeah, let me do that. All right. The space or area under or above a high or low, which has the opportunity to fill orders. Okay. Keyword opportunity. There's a reason it's in caps and underlined it. It's the opportunity to fill orders. Okay. So what does this mean? A lot of people are pretty much taking trades and setting their stop loss. You are probably actually, I don't think I used this in this trade here, but a lot of people will set, like, let's say someone's shorting an Asia session. All right, bring this up here. Someone's shorting an Asia session. Actually, we'll do it off breaker structure. Bang. Okay. So from this low being closed below, this is a breaker structure. Somebody is shorting to, let's just say these lows, whatever. Somebody has set their stop loss at these highs. That means when price comes down and up again, takes out these highs, these people that have shorted, so selling, these people that are selling are forced to buy back their orders here. If someone can buy back their orders, if they are forced to buy orders back, in turn, somebody must sell these positions that is why liquidity sweep up here will then cause a downward shift lower, as in, let me use a better example. Okay, this high is the liquidity sweep. All right, let me get rid of all this drawing. If somebody has actually shorted off, where's the low? That's low, bro. What the fuck is this? All right, somebody has shorted from here. Okay, lots of lows here. We've broke below the lows. We've shorted here. We set our stop losses above these highs, the stop loss above those highs, and we're targeting this low here. Okay, what happens? Not enough sell orders are filled to reach these lows, which in turn makes the price come back up, sweep this liquidity, where, oh fuck's sake, sweep this, let me turn off this magnet, it's pissing me off. Sweep this liquidity here, so orders come up, take out this liquidity. So these people that have sold, that are wanting to short in the market, these people that have sold are forced to buy back their orders at this point here. If they are buying back their orders, that means it gives pretty much the people on Wall Street the opportunity to sell even more orders. So the Wall Street and the really rich people are selling here. The poor people are selling here. And look what happens. We go down and we take out these lows and actually hit the take profit margin or mark, whatever you want to call it. But this is the difference, because a lot of people can say, oh, sweep of liquidity, look, we had this high here, we swept liquidity and we went lower, but we didn't go low enough, blah, blah, blah. It all works and all comes together if you use all the confluences combined in one. There's more theory behind it. If it was so simple that I could just teach it to you in this one video, then and everyone would be profitable, then wouldn't everyone do it? Yeah, they would, but they can't, so it doesn't happen. So this is why you need to watch this video and then go and treat it with market experience and actually learn and put some effort in. So that's the most important thing. Even though I'm going to teach you these confluences, you need to sit down and work and put in time and effort. So the people are forced to buy orders back, which is their stop loss getting hit, which then they sell these positions to Wall Street, let's say, because everyone knows Wall Street is rich. So sell these positions to Wall Street, and as you saw here with this, the people, they sell here, they get stopped out. The real big money, like, you know, the real people of the world sold here and actually made the money. So that's liquidity sweeps for you, basically. And so, yeah, understanding them, hopefully you guys understand them to that extent. And where and why do they show up in the market, I've also explained that. And then to implement them. So the final step, implementation. Why is it, bruh? I don't want the fucking, there we go, implementation. Okay, how to actually implement them. So what are they used for? Daily bias. This is a very big thing. Daily bias, and pretty much for everything. So take profits as well. Take profits and stop losses. So it's for everything. Let's go into this and show more examples of it. Well, yeah, okay. This example that I walked through here about people selling, the daily bias of a bearish daily bias was created as we swept this liquidity. Or, okay, well, I don't know why we're trading fucking Asian session. Nobody trades Asian session anyway. London session, the daily bias here of, or the bearish daily bias here was created because we had these lows here to target. We had that low, and we had this low to target. So liquidity, they are our take profits, and that is what we are targeting. So that's how to use them as a stop loss. And then we also use them as a That's how we use them as a take profit, and we also use them as a stop loss. And the reason we use them as a stop loss is going to link heavily into my next point. So I'll get into that next point. Okay, it's about breaks of structure or changes in order flow, market structure shift, however you want to word it, whatever you want to call it. That is what we're going to go into the next point. But yeah, so take profits and stop losses, and then for daily bias, it would more be. I actually used it for. I'm pretty sure I used it for my daily bias today. So let me just come to the high time frame and come back. All right. Yeah, so I was bearish. So how did I know we wanted to sell here? One, two. Let me go on the 1 hour actually, so they're more significant. But yeah, this was one high here. This was another high here, and this was another high here. That all were taken out. That sweep of liquidity gave me the bearish bias because I know there's a potential for orders to get filled here. Why would sell orders want to get filled here? Because Asia session imbalance, 1 hour low, 4 hour low, and then another 4 hour low that I've marked out, another 4 hour low that I've marked out. All take profits, but all reasonings behind my daily bias. Yes, it sounds simple, and you guys are probably like, oh yeah, this is so obvious. You're gonna go look at your trading view, your charts, and you're gonna be like, oh, it's so easy, and bang, and then you're gonna take some trades. You might win the first one, and then you're gonna lose them all, and you're gonna lose all your money. So don't do that. Please open a demo account if you are gonna do that. But there's a lot more to this than meets the eye. Actually sit down and put some effort in and take trade recaps and journal and all of this stuff before you go in and actually risk your hard-earned money, please. But that is pretty much liquidity. You guys can now identify it. It's just major highs and lows. So, actually, I should probably go through that a bit better. But the way I would like to see it is you've got different types of liquidity. Okay, you've got types. You've got news, highs and lows. You've got 1 hour, then we've got 4 hour, previous day, session. This is the most important in my, well, not the most important, but like the one I use the most, if that makes sense. 1 hour I use mainly if there's multiple of them. So if they're stacked basically on top of each other, but this is basically low resistance liquidity or relative equal highs. So it depends if you've got let me draw it. Uptrend, where the fuck? Okay, uptrend, bang, 1, 2. There's gonna be a third here. This is if they were close to each other. Let me draw a bit better. But if it was like, how the fuck would I do this? Like this. If it was more like the trend was like this. This is the fucking uptrend. Am I being stupid? I'm being stupid. If the trend was like this, we had those 3 lows, and then price did whatever. We've got one. Bro, I'm actually being an idiot. I'm genuinely being an idiot. It is, yeah, it's an uptrend, but the lows are what we focus on. Oh my gosh, I'm being so stupid. Okay, this is not good luck, but uptrend, we do whatever, and now we've got 1, 2, and 3, and see how they're quite close to each other. This is pretty much like, imagine I'm pretty sure TGR said this, I'll be honest, so don't. But 1 cookie, 2 cookie, 3 cookie. If you're here, you might as well continue and go here. And if you're here, you might as well continue and go here. And that's how you fill more orders. That is low resistance liquidity. That is in dense, let's say dense or slightly lower time frame up or down trends. Basically, I look for them on the 1 hour. So like in this is quite a decent case to it, I guess. But you just got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 highs, all like that, which realistically, are we going to have a massive move straight to the upside? Probably not, although yes, we did see him here, but this is because Donald Trump was just saying stupid stuff. But it's more of like a, actually, I literally took my trade today off of this. We had, look at them all. We got 1, 2, 3, 4, and there's ones below this, like even further back in time. You know, oh my gosh, what's going on? All these lows to take out. 1, 2, 3. It's like a staircase. You know, there's just loads of them, so it quickly comes down and takes out all these points of liquidity. That is low resistance liquidity, and then relative equal highs would be like this and this. 1 and 2 highs very close to each other, so that would be a slightly stronger draw in liquidity than if there were 1. But that doesn't mean base your whole bias chasing this, because obviously, look, we continue lower, so don't just be like, oh yeah, buy. There's low resistance, there's relative equal highs. But yeah, that's the different types of it, really. Session highs and lows, quite easy to tell what that is. Previous day, 4 hour, 1 hour, it is, you know, hopefully quite easy to understand the basics of it. But then once you really get into using it, it can become quite a lot more complicated. So don't overestimate your skills in finding liquidity. That's pretty much all I have to say. But the second point is breaks of structure. Break of structure, or market structure shift, is what a lot of people also call it. But you know, break of structure. This is all basically just change in order flow. And what does this mean? We are in a downtrend or we're in an uptrend, and then we swap trends and we go down. Look, this is bullish order flow, we're going up. This is bearish order flow, we change order flow. How do we identify changing order flow? We need to identify it first. That's the first step. Identify. Oh my god, the wrong thing. Oh, what is going on? Let me draw a better. Let me get a better drawing for you guys. Bit of Picasso. All right, try to draw it actually quite nicely. Uptrend. That's quite a good uptrend. Could extend that a little bit. And then extend. Uptrend. Nice. Good uptrend. Lovely uptrend. All right. Breaks of structure. We've got a low here, low here, a low here. If price comes down below this low, not just a wick coming below the low, but the body of the candle must close. If we've got red candle, which means bearish candle, if the low is here, look, and the candle has done this, that is not a break of structure. But if the candle has done this is a break of structure. So that is pretty much just saying we're going against the bullish order flow, leading to we possibly are going to continue and create a downtrend. Or if we are going up, that's an uptrend, we convert it down. But if we're going down, then we close above this high. A candle must close the body of the candle, the big square bit, not this and this. The big square bit must close around or below or above the high that we are going to do. Okay, that's how you identify them. Identify body of candle must close above or below high or low, depending which way you want the break structure to happen. Okay, understand this. So why do we use this as a confluence? Why do we use it? It is because for me, I tend to very rarely take trades off from this. But if I am bearish, we must be in a downtrend to take a short position. This pretty much just confirms we're in a short position. There's entry confluences and continuation confluences. This is a continuation confluence. This shows that we want to continue a downtrend, or we want to, that is the direction we're going for now, at least. Yeah, in this case, you can see it decently, obviously here. Uptrend, low, high, higher low, higher high, higher low, higher high. Look what happens. This candle closes below this low. Candle closure below this low, and we continue lower. That does not mean we instantly short up here. That means we wait for entry confluences, which is my next and final confluence in this video, which would have happened actually right here. And you can short here, and look at this move you could have got off of literally 3 confluences I'm talking about right now. Liquidity, 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 liquidity being swept. Break of structure, which I'm talking about now. Continuation confluences. Continuation confluence. Is price going to continue in this trend? Look what's happening. We're going down. Break of structure to the downside. Continuation confluence. And now entry confluence. Price comes up into this imbalance. But I'll talk about that in a minute. So, understand. Do you guys understand it now? Understand. Do you understand it? What does it mean? It means there's a change in order flow, and are we going to continue in this new trend? This is what we're asking ourselves. If we break structure to the downside, now we are looking and asking this question. Ask yourself this after break structure. Good. That is what we are looking for. Okay. Where and why? So where does it happen and why does it happen? Well, where it happens, okay, it's got a complicated relationship between different time frames. So on the 1 minute time frame, we can go and we can do, we can do this. We can go 1 minute time frame, we're doing this, and then we broke structure, then we broke structure again, and then we broke structure again. Okay. Look, we closed below this low, and then we closed above this high, and then we closed below this low here. Break structure 3 times, okay? But if we then, this is low time frame. If we then zoom out to the high time frame, what does this actually look like? Well, this is just a high time frame uptrend. Okay, so within here, there's going to be low time frame, breaks the structure, and changes in order flow. Each stage is a change, and well, that's where it happens a lot of the time. And why does it happen? It's just to fill more orders. So for an uptrend, yes, to create this up, like this move to the upside, buy orders must get filled, okay? How do we know if buy orders got filled? We break structure to the upside. So if we're in an uptrend and we're going like this, you can't just gamble and be like, oh yeah, I'm buying here, oh I'm selling here, I'm buying here, I'm selling here, I'm buying here. You don't do that. So what do you look for? A break of structure on the lower time frame. We're like, oh, high time frame. I think in this case we might go down on the high time frame. How do I know this? What I do, I go down to the low time frame and I look. Have we broke structure here? Yes, we have. We're going to short, we're going to have the high time frame retracement, and then we're going to continue higher. We take this short position here from the low time frame confluence being a break of structure. Okay. That is where and why they happen, and how do we implement this? Oh my gosh, okay. Implementation. So, I don't really use this for bias, but I'm gonna include bias in it just because, the high time frame, low time frame sort of thing. but I very rarely use it in bias. It mainly is just as a continuation confluence. So once I found my bias, I then look for that to be able to decide and agree, yes, we are going to how do I word it? Okay. If my bias is bearish for the day, so I want price to go down on this particular day and I want to take shorts for whatever reason, okay, but that is just my bias. I am then going to look for a break of structure to the downside, and then that will lead me to think, are we going to continue that confluence? Breaks of structure, there's just changes in order flow. We change to a bearish order flow, and then all I need to look at, are we going to continue this bearish order flow? Yes, and I short. That's how it works. So in this case, I'll use a real example instead of my amazing Picasso drawings. So actual implementation. How do we implement them? On this day here, we are going to be bullish because look, this day here we are bullish because, all right, our bias, like I said before, we use liquidity for our bias. We have swept this liquidity and all this liquidity in Asian session, which makes me think this is Asia manipulation as well as I have just seen the day, and we are definitely going to be bullish. But yeah, well, then we are looking for our continuation confluence, which is a break of structure. Which, oh, perfect. Let me do it here. All right, this candle, this is the high, this is the downtrend. We got a high here, then we go down, and then we come up, creating another high, and then we go down, and then we come up, we create another high, then we go down, and then we come up, and we close above this high. See how the body, the square bit, or the rectangle bit of the candle, not this wick, not the line, the body, this bit, is closed above the high. That is how we know it's a break of structure. And from this point, I'm asking myself, okay, are we going to continue this trend? So the final confluence is a continuation confluence. And you know, I haven't looked at this date before, well, briefly, as you guys have seen. Imbalance. Look, mark out the imbalance. I don't know if the magnets is kind of a bad drawing, but yeah, mark out the imbalance. We tap into this imbalance. We then push out of the imbalance. Actually, this is another time where we will use a break of structure. Instead of waiting, we come in here, and then a whole 5 minutes later, we need to wait for the confirmation that we're pushing out of it. And it's this much price action where we could be making money. So if we're here, yeah, and let's say we're targeting, let's just make Asia session high as our target. And we set liquidity, so the low is our thing. We've got 0.6 risk to reward. So if we're going to use changes in order flow to our advantage, we're going to come back to where we tap in to this. Actually, I'll go back even again. We're going to wait until we tap into it on the 5 minute. We'll tap into the 5 minute imbalance, which we do here. And then we will wait for a 1 minute change in order flow, which also contains inverse fair value gaps. Inverse fair value gaps and break of structure are both changes in order flow. I'm going to add inverse fair value gaps after this at the end as a little bonus. But here, this is an imbalance, which is my final confluence, but we've inversed this fair value gap, which is a change in order flow. And look, we get to enter down here, setting our stops here, meaning that we get to enter so much earlier than if we waited for the 5 minutes. Look, 4.5 risk to reward versus 0.6. So that means if you put £100 on the line, if you set your stop loss at £100, you would have made for this trade, you would have converted that £100 into £459. If you took this trade, you would have converted that £100 into £161. just using this one confluence has almost 10x'd the profit that you can make on a trade. If this isn't proof that these confluences are beneficial, I don't know what is going to be proof. If you need more than this for convincing yourself that you should get into trading and start putting in some discipline, I don't know. Nobody can save you. I don't know what to say. That is how you implement breaks of structure. So our final one, this is going to be out. We're going to add a bonus one later. All right. Bonus inverse fair value gap. Oh, bro, why is it doing this to me? Oh, see, like, you can't be serious. I'm not trying to move the box. I'm making it bigger. Like, how is it doing that? All right, whatever. Third and final confluence. It is the imbalance, or more famously known FVG fair value gap. Bro, who the fuck decides that a box should be this shape? Like, genuinely, get a grip. Shitty Canva designers, bro. All right. Yeah, the final confluence is it actually is an imbalance. That is like, explaining what they are, but it's, on TikTok, more famously known as the fair value gap, FVG, whatever you want to say. But step one, identify. This is the very easy part, very easy to identify fair value gaps. What is it? It's a 3 candle pattern. All right. Candle 1. That's a big candle, bro. What am I doing? Zoom out a bit more. Okay. The 3 candle pattern. Candle 1. We will do candle 2. I need to think about. This needs to be a big candle for the sake of the drawing. Okay. Candle 2 and candle 3. Candle tree. 33 trees. Boom, imbalance from this wick to this wick. It is the gap where there has been no other price action other than just this single candle. So here we are just buying. So a buy order brings us up to here, where we have another buy order, which brings us up to here, which we have another buy order, which brings us to here. We have another buy order and another one and another one and another one and another one, all the way up to here. This is balanced though. This part of the price action is balanced because, yes, we have top of our candle, this bit here, the top of our candle. We then have the next candle, which is this one here, has come down, where this is just buy orders. We've now filled sell orders, sell orders, sell orders, sell orders, and then we bought back up and gone through. But this has now buy and sell orders, whereas this just has buy orders, which basically means there's an imbalance, keyword imbalance, that's where it gets its name from. There is an imbalance in price action, meaning this gap is lacking orders, therefore this is a place where orders can be filled, which makes it a target. So a lot of people use it for take profits, and a entry confluence rather than a continuation confluence. So imagine downtrend, blah, 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 break a structure, continuation confluence, entry confluence into the imbalance and higher, and another even lower time frame break of structure, even lower time frame break of structure, and look, we can enter here instead of all the way up here where the candle might close, for the 5-minute candle close, where we use a 1-minute break structure instead to show that change in order flow. So you can now identify imbalances. Well done. Let me give you a real example with real candles, just so you guys don't get confused. Okie dokie. So there's other types, this is one big imbalance here. Even though, yes, there are wicks, this is one big imbalance, okay? Because look, imbalance here, tiny imbalance here, big imbalance here, tiny imbalance here, tiny imbalance here. This is all one big imbalance. Look what happens. Price comes down, creates the imbalance. We probably broke structure on the lower time frame, and then we come back in, fill this imbalance, fill orders, and then we continue lower. Boom. It's not too difficult. But look, this is a perfect example of why you cannot use these single-handedly for your trading, because you might be going into London session being, oh yeah, let's short, guys. Look, we've pushed out. Look at this, guys. We've swept liquidity. We have, what is this? Yeah, we've swept liquidity. We have created an imbalance. We have filled this imbalance, and we have broken structure. These are all of the three confluences that I have talked about in this video. And look what happens. Oh, we go higher. Oh, look at this. But you've got all the confluences. Why isn't it working? Why isn't it going down? Because you also have all the confluences in the other direction as well. Look, low, sweep of liquidity. Look, break a structure with this candle here. And then on, let's say here, this is where we have the imbalance. I bet you there's a lower time frame imbalance if you go down to the 5 minute, which is what I usually do. But imbalance, and we go higher. Okay, that, it works in both directions. That is why to enter everything is easy and simple, but you need to understand bias and market experience. Okay, those are the most important things above any confluence anybody can ever teach you. I've identified it, you guys understand it. Understanding it is quite easy. It is literally imbalance in price action where there are more sell orders or more buy orders than the other. See, it's quite easy. You guys have identified it as I've shown you with my drawings, and I've showed you with the actual charts. You can understand it as I've explained it to you, and where and why. So where does it happen? Where? So there are breakaway gaps, and just normal FEG, which is fair value gaps. Why do they happen? Which is quite similar to break structure in that sense. As in, a break structure is a change in order flow. This is kind of just proof of the change in order flow. As if we have broke structure to the upside, as we do here, look, we break structure to the upside, breaking structure and changing from a bearish into a bullish order flow. So now going in an uptrend, which means we're going up, which means people are buying. We need a significant amount of buy orders to change this order flow, which often creates gaps. Oh my gosh, something in my throat, sorry. Yeah, so this change in order flow requires a large amount of orders, which then ends up having, so we need lots of buy orders to change this order flow. What's happened here? Buy, 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 buy. We've had lots of buy orders here, which means there is an imbalance. Look at that, guys. Wow. This is a breakaway gap, as on this time frame we haven't tapped into this gap. But if we go down to the lower time frame, which is, remember what I said about the lower time frame and the higher time frames and how trends work differently. Let's see if we create an imbalance and tap into it. Oh, straight away, look, create an imbalance and tap into it, and push higher from that as well, because we're breaking, look, imbalance, highs, 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 break of structure. We're pushing above these highs, creating an imbalance, saying, oh, are we going to continue this are we going to, okay, let me break this down further. Okay, we are bullish for this day. Our bias is bullish. Are we going to be bullish? I wonder. Oh, break structure to the upside. Looks like we are bullish, which is the break structure, which is the confluence I just talked about. Are we going to continue this bullish order flow? Oh, look, entry confluence, imbalance being filled. Oh, so we come out of that, means orders have been filled. In this imbalance of orders, we probably are going to continue this trend. Yes, look what happens. We continue higher. Look, we continue higher. We retrace, probably sweep more liquidity, take out this low, fill this imbalance of price orders, and then we continue higher again. It's it's not that difficult as you know. Well, it is that difficult. It is very difficult, but the basics of it to understand, not that difficult. Okay, this is getting into quite a long video, so bonus inverse fair value gap. You now know how to identify fair value gaps. You understand fair value gaps. You know where they all are. You know everything about fair value gaps. Now you just need to know if we inverse this said fair value gap, which basically is, okay, right here, look, fair value gap. Did we tap into this fair value gap and continue higher? Yes, we did. Right here, look, tap into it and continue higher. Yes, that's bullish, whatever. Here, we have broke structure to the downside. So yes, this is our continuation confluence, but what if these lows weren't here and these lows were all the way, down here or something, and we had this imbalance. We have then closed, see how this candle, it doesn't really matter whether the start of the candle, like here, it doesn't matter whether the start of the candle is above the imbalance or if the start of the candle is in the imbalance, as long as the closure of the candle is out of the imbalance and the opening is either within or above. So maybe we had a candle that does this, or we have a candle that does this. It doesn't really matter as long as we close below the imbalance. This is us inversing this imbalance, which pretty much just gives us, like, the change in order flow has happened. Okay, this is a lot of buy orders. This is even more sell orders, confirming, or no, giving us the continuation confluence, saying we're now in a downtrend. Are we going to confirm this downtrend? Yes, we are, with this imbalance being tapped into here, and then we push down back out of this imbalance. So there you go. Final confluence filled. Yes, we kind of had a fourth, I know, but they link together. It's more of a change of order flow rather than technically an inverse fair value gap or a break of structure. Homework for you guys is to go and identify, 50 of each, 50 points of liquidity where this liquidity was swept, 50 points of changes in order flow, and I want you to see and look at these fair value gaps. Work hard, do the homework, and actually put some effort in, because these confluences can only take you so far. Market experience is superior. Goodbye.